Welcome, everyone. Thank you so much for coming. It's really good to see some familiar faces and some new ones as well. My name is Mark. I'm Head of Risk at APM Capital. I'm very pleased to be presenting a seminar principally about gold and its trading with Bill Purpura here. Just a little bit about APM Capital for those who haven't met us before. We're a regulated brokerage, regulated in ADGM in Abu Dhabi. We've been going a few years now, and we offer CFDs and FX, but we also connect our clients to the world's derivatives exchanges. We do a lot of business with the CME, and we're pleased to be in partnership with them today. Pleased to have Bill Purpura with us. He's been trading for over 40 years. He's been on the COMEX Board of Governors for his 7th term now. Founded Great Lakes Metals in 1987, and it just brings with us kind of 4 decades of experience from trading through the pits to electronic trading. He's CEO of a trading company over here, Great Lakes Trading, which has been going now for 5 years, is it? We're very excited to have it. So please welcome Bill.
All of the noise, but anyway, it's really a pleasure to be here. I want to thank APM and CME for asking me to come and spend a little time with you. What I'd like to do today is I'll talk about what we used to do on the trading floor, and what I'm going to do is go with some of the things that I used, and I was very, very fortunate to find out like around 1980 that talks about human behavior and psychology, and how I was able to mix that in and not go crazy or commit suicide when I was on the trading floor. It's the kind of thing that is just transcendent, and it's still applicable today, not just in trading, but in all kinds of aspects of life. We'll talk a little bit about how the evolution came from the floors to the electronic markets, and I'll talk a little bit about CME, a little bit about the history of the gold market in the United States. There are some things that are really interesting about that. In fact, this year is the 50th anniversary of gold trading in the United States. So 1974 was the first year since 1933 that we were able to trade gold in the United States. So that's when the futures markets began in the U.S., in Chicago and New York. Most of the trading in gold migrated to New York then, but we can get going here. So, we said, my name is William Purpura. You can call me Bill, and this is what I used to do. You take a look at the picture on the floor. These are actually COMEX traders from the floor. So I'm the chairman of the COMEX Governors Committee, which is a committee that is an advocate for, and we're elected by the COMEX members. And we'll go through how the membership body works, and also I'll talk about the benefits of being a COMEX member. So if you're a very large trader on COMEX, it might be something you want to look at. First of all, the CME Group is composed of 4 major exchanges. There are some other ones, but these are the 4 major exchanges in the United States, and they're probably pretty familiar with you: the Chicago Mercantile Exchange, the Chicago Board of Trade, NYMEX, and COMEX. So the Chicago Mercantile Exchange started CME Group. They acquired the Chicago Board of Trade, and then in 2008, they acquired us. COMEX was founded in 1933, and I want you to remember that year because it's going to pop up again, and it's kind of a coincidence and interesting. I started in 1983, so I started 50 years after COMEX started, so don't think I started in 1933. In 1993, the NYMEX and COMEX merged, and then NYMEX had an IPO in 2006, and then we were acquired by the CME Group in 2008. The COMEX still has a legacy membership of members that used to own the exchange until we went public. And there are 772 memberships, and that number doesn't change. So if you want to buy a membership or become a member, you need to and buy one from someone that an existing membership holder. And then the COMEX Governors, again, are advocates. I look at myself as more of a union leader than administrator. So I don't work for the CME, but I'm on the COMEX Governors Committee. So we're elected by those 772 memberships. The COMEX is the largest gold trading platform in the world. And one thing about futures markets is when I define the futures markets, or what the purpose is, the purpose of the futures markets is for risk management and for price discovery. So if someone wants to get rid of risk, there has to be someone that takes risk. And I think probably some people here are the ones that are taking the risk, as I do. And that's where the speculators come in to provide liquidity for the market, and that's what makes the market function. You know, when I started going to China about close to 20 years ago, the word speculation was a dirty word. And it's because they looked at it as gambling, but it's really taking risk. And good traders will assess their risk reward to make their decisions, and I'm sure that that you're all facing the same type of thing. This is what the trading floor used to look like. So I was like one of the guys in the middle over there, and it was really hectic and a lot of yelling and screaming. So that was called open outcry trading. And each one of those areas up here are different pits. Now this is the NYMEX floor. We had two trading floors in New York, one like this, and this is where NYMEX traded. So each one of these areas would be a different commodity. The crude oil was trading over there. I think this was natural gas, but you can see how crowded that trading floor was. We had a similar floor upstairs from here on where we traded COMEX. In COMEX we traded gold, silver, and copper primarily, plus the options. And so that's what we did for a long time. And then somebody had to go and wreck everything by inventing the internet. And so the markets went on the screen, which was actually good, because I'll go through the benefits of having the markets open virtually 24 hours, because it brought the whole world in, and the whole world trades on COMEX. So what I wanted to talk to you about a little bit was how we think about the market, how we thought about the market. And again, this is something that I still do, even though this helped me a lot when I was on the floor. And when we talk about, if you talk about economics, we always thought, because the markets are not rational, that it's very difficult to put classic economics and analyze a market that way. It's important because that means that the market's going to eventually get to its fair value. But there are times when we know that people are not rational, and people make up the market. So there are going to be times when the markets are very hectic, and navigating those situations is very, very important as far as risk management goes. So when I left the trading floor, my employees on the trading floor were street smart guys from Brooklyn. When I left the trading floor and started the proprietary trading and the electronic trading and algorithmic trading, then I had to hire people from MIT, from Carnegie Mellon, from NYU. And when we put the models together, we had to look at real world behavior to create our models. And the thing is, I think Einstein summed it up the best. He said, in theory and practice are the same. In practice, they're not. So you see that in all kinds of different aspects of analysis and model building, and that could be economic models. It could be climate change models. It could be all of these things. The thing about academic models and trading models or climate models, the people that put the models together, if I'm putting my trading models together and I'm wrong, there's a real consequence to it. In academia, we'll put models together, and if they don't work, a lot of times they'll get more money to fix them. So in trading, your models are so important, and if we do strict supply-demand, efficient market hypothesis type of thing, it doesn't really work because the markets, again, are not rational, and even though the underlying economics will bring it back to its fair value. Around 1978 or 79, there were two Israeli economists, Daniel Kahneman and Amos Tversky, and they came up with something called prospect theory. So these days we hear a lot about confirmation bias, especially with all the news that's coming in. With social media, online cable news, and everyone has an opinion. When we go there, there's not that much journalism that goes on. Okay, most of the stuff we hear are opinions, and we're bombarded with so much information that we wind up getting into, what's been called analysis paralysis. So if we're trying to figure out the markets, what's going to happen here with inflation or whatnot, it's very, very difficult because all of those become subjective, and a lot of times it becomes subjective because of our biases, our confirmation biases, and I'll go through a little bit of those too. So what we put into our models is what we're going to get out. If we put bad information in, and that information may be tainted because we have a bias towards certain information to kind of confirm our bias or what our opinion is, that can skew the model so it doesn't work as well. There was a social economist, Herbert Simon, and he said a wealth of information creates a poverty of attention. So that's why we need help in processing all of these things, and that's where our algorithms and computers come in. The interesting thing about Simon is that he said this in 1970. And I think if he was alive today, his head would blow up, because back then we had newspapers, and back in the US we had like four networks on TV, 3 or 4 networks on TV, and that's how we got our news. Newspapers and just local TV news and national TV news. And this is when he put this up. There was a lot of information back then, and so just think it's on steroids now. We get so much, we're just bombarded with information, and the challenge is, how do we sift through this? So prospect theory was trying to explain how people make decisions. So they did a lot of experiments on people, and they found out that most people are risk averse. They're not going to, and it translated into trading, one of the biggest problems we have and we see is people not taking their loss when the market tells them to take their loss. No one wants to lose. And we tend to value things that are personal to us. So for instance, if you have a house and you go to put your house on the market, you always think that you should be getting more for it because you've got that attachment. Okay, so your bias is there, and that can skew it. The market is going to be the market. It's not going to care what you feel it's worth, but that's whatever the market is going to bear. So prospect theory talks about these things, confirmation biases and things like that. So if I have a political opinion and I'm going to cite things that are going to support my opinion, and maybe I'm going to not pay attention to data that's just as valid that contradicts my views. And it's the same thing in trading. If I think gold should go to $5,000 an ounce, and I'm going to look for information that confirms that bias. Oh yeah, inflation's coming up, the US dollar and federal debt and things like that. Okay, but there might be some other things too. There might be something coming in. The central banks have been buying a lot of gold, and we'll go through that a little bit. But what if they start dumping the gold like they did back in the 1990s, where they actually had an agreement to stop selling as much gold? Those kind of things can change. I'm not saying they're going to do that now, but I think it was about 4 or 5 years ago, Sri Lanka, the central bank there had bought a lot of gold. And we got some calls from some people in the government saying, hey, you want to buy some gold? Because they were quietly trying to sell it. So when we hear central bank buying and selling, we always hear that this time it's different, but it always tends to be the same. So, but as I'm going to show you, there's a slide that I'm going to have on here that might make it a little bit different this time. So again, these are some of the concepts of prospect theory, and again, the value function, which I talked about. My cell phone, if I just sold my cell phone to someone, it's going to be worth more to me because all my information's on there, but that piece of hardware is going to be the same value into the regular market if we went to resell it. And it's just like anything else that we have. We might have a car that we have. We always think that what we own is worth more than it is, and that's just an internal bias that most people have. The other thing is about diminishing sensitivity. Okay, the larger our losses or gains get, the less sensitive we wind up being. And that's particularly bad if we're taking losses, because the first ones are painful. It's painful at first, and then the pain kind of subsides a little bit. There's a diminishing sensitivity to that, which is something that you really have to watch. And that's why when we're trading, we really want to look at objective criteria and have a plan and objective ways to get in the market, objective ways to get out the market, rather than seat of the pants and just what our subjectivity tends to affect our decision making. And then if we look at like number 6 here, reference dependence, there's a reference point that we'll have that may affect our decisions. So if I bought a stock, say at 55, okay, and Patrick bought the same stock at 60, and the market starts coming down, and let's say it's trading at 57, and we both get the same objective signal to sell, I might be more willing to sell because I got a little profit. He may be reluctant to do it because his reference point is a little bit higher. Yet the market is telling us, we're using the same kind of system, say, the market is telling us that it's time to sell. Okay, but that reference point that we have might affect our decision making. So when I was on the trading floor, it was really important to do that. And this thing really hit me, and I started looking at it. And when I started going onto the floor, it calmed me down a lot. It let me think. It let me be more objective. I was clearer in the analysis. You know, the U.S. military came down to the NYMEX, and they wanted to see how we made decisions in that hectic kind of environment, because and to study that for their operations too. Because let's face it, it's way more serious to make decisions on a battlefield than it is. You might lose some money rather than lose a limb or your life, but they wanted to translate that kind of thing into their training. And it was really interesting because we had these kernels and things, and we did mock trading where when you saw on the trading floor where we were trading like that, and they were blown away by it. Now, obviously, we had an advantage because we were so used to doing it, but we used to have bankers that would come down that were actually our clients when we were brokering on the floor, and we put mock trading onto them. And one of the reasons we did that was to show them that next time you tell me that I got a bad execution for you, you try it and see how easy you think it is. Okay, so we used to tease those guys quite a bit and do that. So this is a book that I recommend reading. We gave this when we had our proprietary trading company that I set up in 2011. We set up a company that arbitraged gold from Shanghai to New York. So we were members of the Shanghai Gold Exchange. I was an advisor to them for years, and so we were the first wholly foreign-owned company that was allowed to trade metals in China. So we set up an arbitrage, and we were a market maker pretty much for the Shanghai Gold Exchange. So this book, Thinking Fast and Thinking Slow, it talks about a lot about heuristics. So what are our, kind of like our knee-jerk reactions to things? If I'm driving a car, okay, and I see the light turn red, I don't have to think, oh, red means stop, and I pick my right foot up. Well, I don't know which side of the you guys are driving on. But in America, as I pick my right foot, I got to take that off, put it onto the gas. I don't have to think about that. I just do it, right? Now, a lot of times, so that's very valuable to us. And we need that type of thinking in everything we do. But sometimes we have our knee-jerk reaction. If it's in trading, we have to think about it because it could be wrong. You know, our impression, we might make an internal assumption. So way back in the 80s, one of the most brilliant guys that ever traded was actually a friend of mine and a customer, and we worked together. I used to do all of his floor brokerage in New York, and he started out, so if I told you that the price of corn is high, is going up, and has gone up, and the price of wheat is low, which one are you going to buy and which one are you going to sell? So what would you think? If corn is up and wheat is down, which one are you going to buy and which one are you going to sell? So, okay, you're going to buy wheat and sell corn. That was wrong. Because what he said was, I want to buy the market that's strong, and the market is telling me that corn is strong and that wheat is weak. So he would buy corn and sell wheat, okay, because he was a trend follower. So it was very, very interesting because the theory there was buy high, sell higher. But you wanted to assess that the market had was breaking out. That worked really well in the 80s and in the 90s when we had these trending markets. And if we take a look at markets now, like the coffee market, take a look at that. If you would have been right in the coffee market and taken your profit quickly, you would have left a lot on the table. And trend followers would make most of their money on a few of their trades. Not that they lost all the time, but a lot of trades, because they're managing their losses, a lot of trades would be neutral to small losses, but when they did hit, they let it go. And that's where a lot of the money was made. So a lot of the early fund managers, commodity fund managers, were trend followers and did very well that way, but they were disciplined. They had objective areas to get in the market, objective areas to get out of the market. Now, so this book, Thinking Fast and Slow, was written by Daniel Kahneman, who was one of the guys that came up with prospect theory. And this book came out probably about 8 years ago. And Kahneman won a Nobel Prize as well. But he talks about type 1 thinking and type 2 thinking. Type 1 thinking are those heuristics, the fast thinking. The slow thinking would be like our strategies. So if we came up with a trading strategy, take for instance the arbitrage, that we did, and if any of you are doing arbitrage, you do the same thing. Your slow thinking is putting the strategies in place. These days, the fast thinking is done by computers. Okay, when we're doing that type of trading, we're just not pecking at the machine all day. The computers and the algorithms are doing that fast thinking for us. We still need that slow thinking because markets might change, okay, and we may have to change our parameters. So we had traders. We didn't just flip a switch and go out and play golf. Okay, we always had the traders monitoring those markets. And one thing that happened one time is I was actually in Beijing, and I was at the Great Wall with a guy from the central bank. And at 9 o'clock in the morning in China, which was 9 o'clock in the evening in New York, China wound up doing something with their exchange rate. So what happened was we wound up losing a lot of money because our algorithms just kept adding on to a losing position because that was an unexpected thing. If we didn't have people in front of the screens to say, hey, wait a minute, something's wrong, and then readjust things, that could have just gone on and on and on. There was a company in New York, Knight Capital, and Knight was probably the biggest market maker in the world in equity. They almost went out of business. Well, they did go out of business in about 2 minutes because somebody had stuck the wrong system in, and within 2 minutes, they just lost $100 million or something like that. And it just shows you that the human element always needs to be there when we're going. And I don't know what's going to happen with AI and things like that. Hopefully, you know, I'll be worried. My technology worries will be a GPS on a golf cart and a fish finder at that point. But it's going to be interesting to see how that works and how that plays out. And again, remember when we talked about models, garbage in, garbage out, who's putting the data into these different AI models too when that happens. So it's going to be really interesting to see how that goes. But this is a great book to read. We had all of our traders read that. When I was doing some classes for the University of Macau, I used to give these to all of the graduate students over there to read. So what we want to do is, I'm more concerned with price. Why? Because price, it's a number, it's objective. Okay, you can see it, you can measure it. What the idea is to study how the price moves and try to see what this objective data and what the price movements are, what are they telling, what is the market telling me? Okay, because the market doesn't care what any of us think. All right, it's not going to listen to us. We tell the market, you have to do this, you have to do this. It doesn't care. So the really art of trading, more than the science of it, is listening and observing the market and what's it telling us. The corn and wheat example we used before, the market's telling us that corn was strong, wheat was weak, okay? So I want to take a look at those price patterns. I want to take a look to see how is price reacting to this. Is price telling me that maybe it's overextended on the upside and getting overbought? So those are the kind of things that we need to look at. That goes into that slow thinking when we're doing our strategies. Our fast thinking is, whether we're trading with an algorithm or not, is when that's hit, are we going to execute whether we're right or wrong and listen to what the market says. Okay, so again, I want to talk a little bit about market bubbles, because this is where the irrationality comes in. And I'm going to give what I consider the poster child example of irrational behavior and market panics, and we'll get into that in a little bit. And it's something that we're all familiar with, that we all know everything about. So again, these bubbles will happen throughout history. They happen all the time, and we'll go through some of them, but these are the stages of a market bubble, okay? Something is going to catch investors' attention or traders' attention. You know, it might be something, and everybody starts to react the same way, and it's almost like a little bit of a herd mentality, which is what it turns into. So let's take a bubble on the upside, which is really the typical bubble will be the market going up, is prices start going, and then there's some momentum, which would be, we talked about the trend following, and more investors start jumping into the market. But we see if it gets overboard, where this euphoria, as Alan Greenspan said, irrational exuberance starts happening. Okay, and I'll go through some of these examples throughout history on this. Then finally, we're going to see some profit taking, and then a lot of times there's a panic to liquidate. But as we'll see in the examples that I'll show you, is that the market is going to correct to its fair value. The key is, as it's going through this bubble and through this stage, is how do we react? We can be right in the market because it might be overbought and it should be sold. We think it should be sold because it's overvalued, but if it keeps going, you have to have pretty deep pockets to be able to buck the trend. So these are some of the bubbles that have occurred throughout history. Is anybody familiar with the tulip mania? Okay, I'll go through that. And then we have some other famous ones, the dot-com bubble in the US that we had, the US housing market, we had a bubble there. There was a bubble here in Dubai, I think around 2008 or 2009 in real estate. Yeah, which was really interesting because in 2007 I came here, there was a brokerage firm that was opening an office here, a Chicago brokerage firm that was opening an office here, and they asked me to talk about the gold market at this event that they had. And someone came up to me and said, if I gave you money to trade gold, what do you think you could make? What kind of return? And I said, well, it all depends on your, your risk profile and things like that. If you wanted me to be fairly aggressive, I think I would shoot for like 15% maybe. If you wanted to be conservative, maybe 8%. Guys, no, I'm making 40% a year. That's one way, unless there's a lot of rental income. You can't just go up 40% every year. And then look what happened. So there was that bubble, and then we also had these black swan events too. Two major black swan events, and I'll talk about them a little bit, in my lifetime, really, were 9/11, when that happened. And I'll show you the consequence on the US federal debt because of that. And then we just had the pandemic. Those are the two things that, the two events in the last 30 years that totally changed the world. I'll go through the first major bubble that we had in gold, and then in oil too. Do you remember when oil, this is the opposite way. When oil went negative, the WTI oil on NYMEX went negative because there was no storage available. If you took delivery, you had no place to put it. So it was worth less than zero because you had to pay to get rid of it. Okay, now the whole market didn't do that, but we saw the oil market go down, the cash market go down to like $10, $8, something like that. So that was like a bubble on the downside. A lot of that was caused because of the effects of the pandemic. So this is what happened with the tulips. And this was all the way back in the 1600s. So in Holland, for some reason, everybody wanted, these tulips became very popular. And they weren't the flower, they were the tulip bulbs that you would plant. And they became very valuable. So look at what happened with the price on these things. And just take note of that pattern. And remember what we talked about, the different stages, okay? We had this displacement event here, then the euphoria, and then the panic. So there was a story, there was a book that was written, I think it was like in 1830, by this guy Charles Mackay, called Extraordinary Popular Delusions and the Madness of Crowds. And he goes into detail on this thing, and there was another one that he had called the South Sea Bubble, which was a real estate thing that was happening in the New World, in North America at the time. But there was a funny story in there. Well, I don't know if it was funny for the guy that got thrown in jail, but a guy had been out to sea for about 3 years. He had no idea that this was going on. He was in a bar, and he saw this tulip bulb on the bar, and he thought it was an onion. And he ate it, but it was like a prized tulip for somebody, and he wound up going to prison because of it. So again, why would tulip bulbs be? It's not rational. Okay, so again, we talk about rational behavior, and if we were doing just a strict supply and demand for tulip bulbs, for the utility of them, they should have just been where they started. So throughout history, we see some of these bubbles. So we saw the tulip, the South Sea Company was another one that happened in the 1700s. But then take a look at the stock market crash in 1929. You see the same type of patterns. You see these parabolic moves. When we see that coming up, we have to really be careful, because that's when that euphoria comes in and people aren't thinking. They're just closing their eyes and they're buying. Okay, and then the one all the way on the right is the NASDAQ, with the dot-com bubble that we saw. Now this is really interesting because this is the Chinese stock market in 2015. And notice the pattern again and all of the elements that are in a bubble that we talked about before. So the thing that's interesting is in March of 2015, there were 4 million new stock accounts opened in China, but they were by people that had never traded before. 2/3 of those people didn't have a high school education, and I think it was 6% of them were illiterate. And so that was right here. So you had all of these people coming into the market, and what are they going to do? All of their friends are making money, everybody's making money, so they just come in, they don't care about price earnings ratios or company reports or anything like that, they're just buying. Okay, and I think the brokerage firms were a little culpable for that because they were opening new accounts. The brokerage firms were making money, and then we see how the market corrected. There was profit taking, and then the panic. But then, if we just cut this out, we see where the market returned to. Okay, was to its fair value. So the market is going to find, water always seeks its level. So the market is going to eventually get there, but there might be a hurricane in the middle that causes, what happened here a couple of weeks ago? You had a lot of water. And so this was really interesting. And the problem that happened though, one of the reasons that the market continued higher is the government was coming in, and this is the stock index future in China, the CSI 300. They were coming in at the same time every day with some buy orders to try to keep the market up because they were really afraid that there would be some social unrest if the markets collapsed. So as a trader, now we didn't trade this, but we noticed it, but we never traded it. We were trading commodities. We were trading mainly gold and copper in China, but you knew they were coming in every day, so what are you going to do 5 minutes before they come in, before that time? People were buying, okay? The government would come in, knock it up, you sell it to the government. So that helped keep the market up a little bit too. So all of these contributing factors, this euphoria, easy money, the same thing that happened in real estate here. So we talked about this, but one of the things that happened was when the market started coming out, the regulators needed a villain. They needed a fall guy for that. And so they were blaming the messenger for this crash. And the messenger was the bad guy were us speculators, supposedly the speculators. The evil speculators came there and drove the market down and knocked all of these people out of business. But those were the ones that were actually trading, looking for signals, looking for the market to give it a sign that was weak, and then trading it. The problem that we had was the regulators came in and put these draconian regulations, starting with the stock market. That CSI contract went from trading, they were trading close to 1 million contracts a day. And they went down to about 20,000 after these regulations came in. So it really killed that market for a while. We were kind of keeping our head down as commodity traders, hoping that they wouldn't come into the futures markets, but they did. They started restricting how many orders we could put into the futures market. We had an arbitrage exemption that they took away. So we started trading the spot gold in China and the Shanghai Gold Exchange. And then that was controlled by the central bank. They came in and put the same kind of regulations in. So we had to change all of the parameters from our trading, and then they also started making it more difficult to move our money around between, we were moving it into Singapore and China, and then we wound up saying, okay, it was a nice little run there, and we sold the company at that point. But just governments, when governments come in and try to pick winners and losers, okay, they're going to distort the market. So sometimes you're going to see a market distortion because of that. And that's an irrational player coming into the market as well. So when we look at something, and let's take gold, these are some of the factors, and what do we watch? Okay, we see inflation, interest rates. If the Fed raises rates, we're going to see we might see it come down, see the market come down. South Africa is kind of outdated. This is an old slide. That's when South Africa was the largest gold producer in the world. They're not even the largest in Africa anymore. Ghana is. And China is actually the largest producer of gold. They're the largest producer, and depending on the season in India, China is also the largest buyer of gold too. The problem with China is that's all contained in the country. They don't allow much of the gold to be exported out of the country, even though they're the largest producer, and they have import quotas, so it's very difficult to sell gold into China. You got to get it into Hong Kong and then go through all of this stuff to get it done. So Indian demand is very important in gold, okay, with the different seasons and the Indian market. They say that a lot of Indians will wear their wealth, okay, because it's big in jewelry. Oil prices, these global tensions we have. Look what's going on in the world right now. We've got the largest land war in Europe since World War II, the most chaos in the Middle East that we've had since the 1970s. And so we have all of these global tensions. But then how do we quantify these events into making a trading decision? See, that's why if we start looking at these factors, and we talked about the information onslaught and all of the avalanche of information that's coming in, it's very, very difficult, okay, to make a decision based on that, because a lot of times these factors may already be in the market. Okay, so one of the things is that we would look at is, let's say some bullish news was coming out, but the market didn't really go up and then started drifting down. What's the market telling us? Okay, we've got that opinion it should go up because of this bullish news we heard, but the market is saying, well, wait a minute, it's a little weak. Maybe that was already in the market. All right, and there's an old saying that said, buy the rumor, sell the fact. Okay, so a lot of that still applies when we're talking about directional moves in the market and where it's going. So we'll start talking about gold, and this was really interesting because in 1933, President Roosevelt signed an executive order that all people in the United States, citizens of the United States, had to turn their gold in. Now, jewelry was okay, and if you had collectible coins, but if you had gold bullion, which a lot of people did, you had to sell it back to the government, and they took all the gold, and you could go to jail if you didn't do it. And what they did was they paid the official price for gold, so the government would pay you for it. I think the price then was $26 an ounce was the official price. In fact, the official price for gold in the United States, but from the U.S. Treasury right now, is $42 an ounce. Okay, so on the books, the U.S. gold reserve is valued at $42 an ounce. And I'll explain why that got really crazy. So they were buying it back at 26. So what did Roosevelt do? After he got everyone's gold, he raised the official price of gold. Now all of a sudden, a lot of the national debt was wiped out, okay, because the dollar was backed by gold. All right, so it was like an arbitrary thing. That's why I say when governments do things, be careful. So in the 1960s, I think the official price was $36 an ounce, $35 an ounce. But the market price was over $100 an ounce. And U.S. citizens couldn't do this because they weren't allowed to own gold. But if you were from here or from someplace else and you had U.S. dollars, you could take those U.S. dollars and get gold for them. So if I gave the government $36, I would get an ounce of gold, which is worth 100. That's a pretty good trade. So some of the governments, particularly France, de Gaulle came in took a bunch of US dollars that they were holding and they turned them in for gold. So the US stocks of gold went from 25,000 tons down to what they are now, which is about 8,300 tons. Okay, so 2/3 of the US gold went out the door because of this trade. So in 1968, President Nixon closed the gold window and stopped allowing the dollars to be converted into gold. Then in 1974, President Ford signed an order that allowed US citizens to own gold again, and that's when the futures markets were allowed to happen. So in Chicago and New York, we opened the futures market. So COMEX started trading gold. And so the interesting thing when we talked about when COMEX was formed, okay, it was 1933, the same year that Roosevelt said you couldn't trade gold. But at that time, COMEX, I think we traded silk and rubber. That was the exchange. It was the commodity exchange in New York. So it wasn't until 1974 that we were able to trade gold. And again, this is the 50th anniversary now of gold trading in the United States. And in New York, when we have the COMEX dinner, the gold dinner every year, they're going to make a big deal about that. So hopefully it'll have better food. Okay, so what drives gold prices? Since 2003, gold prices have largely been driven by investor demand. Okay, and this kind of shows it. These charts, so the shaded area represents gold holdings, which are the ETFs. So what happened when the ETFs were formed in 2003? Gold was securitized. So if you were an asset manager trading equities, you weren't allowed to trade commodities for the most part if you're managing people's money. Now you could do gold. Why? Because they make gold a security. So that brought a lot of investor demand and fund managers and things like that. And that's, if you take a look at the correlation of the price of gold with these holdings, it's very highly correlated. Okay, and gold is a store of value for the most part. Okay, so that's why that correlation happened, but we're going to see where it is today. Now, if you take a market like silver, you see that that's nothing like this. Okay, these are the ETF holdings in silver, and you can see the silver prices weren't that correlated. Why? Well, the silver demand is more industrial than it is investment. Okay, so silver is going to be more subject to industrial demand. Now, the biggest use of silver for a long time was in photography. Okay, developing film. Well, what happened in photography? We don't take our little rolls and bring them to the drugstore and have them developed. Okay, everything's instant now, and when that change happened, everybody thought that's the end of silver. It's still used in X-rays and things like that. But silver is an amazing metal. It's got one of the highest antibacterial properties of any metal, of any substance. So it's being used in hospitals a lot. They treat tables and clothing because it stops infection. There was a company in Pennsylvania, close to where I live now, that got this technology where they would treat clothing with silver nitrate. And what it did was it stopped odor, so you didn't smell. I used to wear it on the planes when I'd fly to China, so you didn't have to worry about smelling. And the military would be using it so they would treat socks, so soldiers could, and anybody could wear these socks that were treated and not worry about about bacteria. And also it helped with the clothing treated if you were in the military, if you got shot, okay, because that antibacterial helped ward off infections and things like that. So we say there are some doctors that'll treat like strep throat with silver compounds. So that found this. That's one new kind of thing that they found. But silver is also so important in electronics and other industrial things. But again, the point is that it's more of an industrial metal, whereas gold is more of a store of value. Gold has great industrial use. You know, there's gold in our cell phones. But the thing about gold is, when we look at gold, why is it driven by demand? It's because the supply doesn't change, other than getting added onto incrementally by the new mining that comes in, because gold doesn't go away. Gold will change shape. It might go into jewelry, and it'll change ownership. But it's still there. That supply of gold is all there. All of the gold that's been mined for the last 5,000 years can fit into an Olympic-sized swimming pool. That's all the gold in the world, everything. And again, unless it gets shot into space and it never comes back, or you wind up dropping it in the ocean, all of the gold is still here, and it's all recyclable. So gold coming from phones, when we get rid of our phones, that gold gets pulled out. Okay, so again, so the gold is driven more because it's not really consumed. So it's not consumed like a perishable commodity would be, like it doesn't get burned up like oil or used for food. Okay, so that there can be supply disruptions in that, but the gold supply is pretty much static. So who's buying the gold and what are they doing with it? How much are they keeping off the market because they're storing it? So again, investment demand is what's been driving gold prices. Here's what's been happening though. So this is the same concept. We can see the correlation, if I can get this to work. Okay, with ETF holdings, you can see how that was, until just recently, we see a divergence here. Now, some of that is that central bank buying that we were talking about, because what's happening now with the US dollar? You have these countries, the UAE included, that are joining the BRICS, looking for alternatives to the US dollar and trying to get that in. I don't think it's going to work as fast as they think it is, but that's another story. But I think that is why we see the investment demand and the price is diverging a bit. Okay, because we're seeing this big buying coming in from central banks. China's accumulating a lot of gold, and I think that's what's in the market right now. That doesn't mean that it's going to continue perpetually, but again, I think that's what's causing that divergence between the investment demand and the price of gold, which we haven't seen for 20 years. So it's an interesting time. Oil is the other political market. And one of the biggest things that we have right now is the war going on in Ukraine. But this is what's interesting about Russia is a resource-driven economy. And oil is the most important resource that they have. So when I was looking at this, it struck me that in 2008, when oil went to $100, what happened? Okay, Russia went in and invaded Georgia. Okay, why? Okay, their coffers were filled up, all right? They had the money to do that. Now you see what happened. We had a sharp drop into 2009, and part of that was because of the financial crisis. Hangover from that. Now oil starts coming back up over 100 again, and look what happens. They go into Crimea. They had the money to do it. The next time it went up is the latest when they went into Ukraine. So you have to wonder that if oil prices had stayed lower, would he have gone in and done it again? We don't know. Likely he would have done something, but and the other thing that's happened now, though, is that the thing that drove this up to actually where Russia could make more money, ironically, were the sanctions that the U.S. put on and that the West put on. Because even though we couldn't buy Russian fuel, guess who was buying it? Initially at a discount. China and India. Okay, they said, we need this stuff. We'll buy it from you. Okay, so it actually backfired. Caused the price of oil to come up. That was one of the factors that had oil come up. But at the same time, it made Russia stronger. And a lot of it was caused by people that wanted Russia not to be stronger. So again, we talked about governments getting involved in markets. Sometimes it doesn't make much sense, or sometimes it'll backfire, and it's not really thought out a lot. You know, in the U.S. right now, oil is political in a domestic sense too. When gasoline prices were very high and diesel prices were high in the U.S., they released oil from the strategic reserves that we had down to where it was. They almost drained it to try to politically push the price down, you know, for political reasons. Now, they just announced that there's a strategic gasoline reserve in the northeast part of the United States in case there are hurricanes and power outages, that there'll be gasoline for people. They're draining those now to try to get the price of oil down. Remember, this is an election year. They're trying to get the price of gas prices down because that's what people are all upset about in the United States is inflation. High gasoline prices, high food prices, higher food prices because of higher diesel prices, because you got to transport the goods around the country. So all of that stuff is related. Okay, there's a butterfly effect to that. And transportation and diesel prices are very, very important, and they affect all of the prices that we have. So with the U.S. policy of trying to discourage fossil fuels and fossil fuel discovery and drilling and pipelines, where I live in Pennsylvania, if we were our own country, we would be the 5th largest producer of natural gas in the world because of the technology, the fracking technology that we have. We have so much. The U.S. has probably 200 years worth of energy just in natural gas, from Marcellus Field, where I'm at, the Bakken Field in North Dakota, and the Permian Field in Texas. There's enough natural gas there to power the U.S. for about 200 years. But it's being discouraged. And what do you need to transport the gas? You need pipelines. So pipeline permits are down. So again, that's how political this stuff happens, because of the move to renewable energies and green energies. My opinion is, if we try to get there too quickly, you're seeing some of the effects of that right now. Part of that is with inflation that we have and higher energy prices. Okay, so let's take a look at the federal debt. It's out of control right now in the United States. And what I did was I put what it did under each one of the administrations. Now, it's not saying that each one of these presidents caused it, but it just shows the political power that was in when this happened. So we see it start to go up with Reagan. And a lot of that was the Cold War, when a lot of military spending. We tried to outspend Russia to bring Russia to their knees, which worked in that regard. And then when first George Bush came in, we had a savings and loan crisis. So they spent a lot of money bailing out the savings and loan countries. That was one of the things. So the government was in there trying to solve problems by spending money. And then when Clinton came in, you can see how it flattened out a bit. All right, and one of the reasons where it really flattened out, we actually had a balanced budget in 2000. And it was an interesting study, because what happened was the legislature was all from the other party, from the Republican Party. Okay, and they actually worked together. And it was great. So in 2000, we were hearing people saying that the United States, if we keep on this track, by 2010, we'll wipe out the federal debt. But look what happened. And one of the things that happened was one of those seminal events that we talked about was 9/11. When 9/11 happened, everybody took their eye off the ball. Fiscal responsibility. Everybody was worried about the war on terror. So we were spending and spending and spending. And you can see under George W. Bush, how it's spending, and the deficit began to accelerate. Then in the Obama years, when we were coming out of the 2008 financial crisis, we did a lot of spending, bailing out some of the car companies and things like that. So now it almost became like they were intoxicated with spending. And politically, it was not as, there wasn't the stigma as much, and people weren't really paying much attention to it. So during the Obama years, we added more debt than had been accumulated all the way from the time of George Washington until then, just in those years. Now, it kept going during the Trump years, and numbed, you know, we don't look at it. So again, this stuff doesn't affect people. We're talking trillions and trillions in here, and no one blinks an eye anymore. That's why we wind up with this kind of nonsense. Now, this is global debt, public and private. And we did have a drop because of the pandemic. It's $238 trillion. Okay? So it's just, you know, what's going to, I don't know. I'm not smart enough to figure out what to do about it, or really smart enough to know what the eventual effect of it is going to be. But what it's really telling you is that look at Bitcoin and things like this, alternatives to fiat currencies. Gold is going to act the same way, I think. I think fundamentally, this is something that's very bullish for gold. Now, again, I'm not going to predict where gold is going based on that. I'm going to watch to see what the market's doing if I'm making trading decisions. So, this is an example of confirmation bias. Okay, when we have an opinion on the market of where gold should be, and we use gold specifically. So if you take a look on the left, the little circle on the left is the 1980 high, which was $850. That was the record price gold at the time, and that's kind of like when I started trading. So we hear people say that if you adjust the price of gold for inflation from the 1980 high, it should be trading up here. Well, I was at a conference and somebody brought that up, and I said, well, why did you pick that number? And they said, well, it shows where it can go. The interesting thing that people don't really realize is that, like I said, I was actually on the trading floor when we were trading, and we looked up and we saw that price on the board. We said, where did that come from? We didn't see it trade, because we were trading about $100 lower at the time. That was like a flash trade that went up. But there was very, very little gold that traded at $850 on that day. And look what happened to the market right after that. We had the same type of thing as we saw in the other markets with the parabolic move and then the correction. So that was a bubble. But why pick that number? So I was at an event in China, and a guy brought this up, and I said, well, what if we adjusted gold for the price of inflation from another important time, say from 9/11? Where should it be trading? Okay, and this is what we're looking at. If in 1980 we adjusted it for inflation from that $850, $3,200. Okay, if we did it from 2001, okay, so that's the whole thing. So I think Mark Twain said it best. There are three kinds of lies, damn lies, and statistics. You can make statistics say whatever you want, if you want to do that. All right, so when people come up with this kind of thing, just question it. That's my advice. I just, you can always make a case for something with statistics. Thing is, when you're building models and you use statistics the wrong way, it can get kind of painful. Okay, so this is like a petri dish of all the stuff we've been talking about irrational behavior, emotional trading, things like this. This was on November 8th, 2016, on election night, when Trump was running against Clinton. Clinton was expected to win, you know, and that's what everything was. So the markets were pretty steady. This chart is, each bar is a 5-minute chart. So this is COMEX Gold with a 5-minute bar chart. And it's going through election night. Oops, the wrong thing. Okay, so you can see as the returns were coming in, the market was pretty flat. But around 11 o'clock at night in New York, the gold market shot up and continued up because those were when the returns were coming in and it was apparent that Trump was going to win. And people were saying, oh my God, what's going to happen? The world's coming to an end. I mean, that was the market, the psychology. So you can see what happened to gold, how it shot up. Now remember, each one of these bars was only 5 minutes. Okay, so as Trump looked like Trump was going to win, that's what happened. What happened to the equity markets? Okay, the US dollar and the equity markets both collapsed in that same time frame. Now, there's so much that you can unpack from this. First of all, everybody was hitting the same button at the same time. They had that same heuristic, that knee-jerk reaction to that news. All right, so the global equity markets collapsed. So did the US dollar. All right, and the other thing is, remember when gold was going up. That's a case, if you're doing asset management, to have non-correlated assets in your portfolio. Gold would have relieved some of the pain, you know, jumping out the window when you saw the equity markets collapsed if you were heavy in equities. If you had some gold in your portfolio, it made it a little easier, you know, to hold the fort. But then you saw how the markets came back up. So this was like the opposite of those bubbles. And this, again, this is only within a few hours. So every time frame, you can see these kind of things happening. Now, if you're trading, you have to, again, if you have an objective area that you're going to get out, if you're wrong, you would have saved yourself a lot of money, because you would have probably, a lot of people had to bail out because they ran out of money because it came down so fast. And the same thing with the US dollar. So this was really important. So again, it teaches us about about psychology, about herd mentality, about confirmation bias, about, you know, preconceived notions and herd mentality, all in one. And it also teaches us a little bit of a lesson about putting non-correlated assets together in a portfolio. Yes?
Talking about time frames, I'm afraid we might have reached the end
Uh-oh. Okay.
I think we may have to bring you back to carry on talking.
Okay, we can do a part 2.
I think definitely we need to do a part 2.
I was going to tell you where gold was going. That's okay.
I don't think we've quite finished the story. So
No, that's good.
I'd like to thank you so much.
Great.
On behalf of APM Capital, on behalf of the CME Group, it has been an absolute pleasure to have you here. Thank you so much, everybody, for being here today. I think this is our best audience so far.
Great.
Thank you very much.
Well, I hope you enjoyed it. And it was really a pleasure for me to be here. As you can tell, I could talk for a long time.
So,
I had to.
just outside, you have QR codes, so feedback. I'm sure if you're able to give feedback, it can only be positive. I'm such a wonderful speaker.
Thank you.
Ideally, your feedback would say, bring Bill back. I know you're going to go back to Pennsylvania for the summer, but in the autumn, when you're back here in Dubai,
Yeah, coming back for good.
if you want us again. And it'd be an
Oh, I'd love to.
For me, it'd be an absolute pleasure, sir.
Thank
so
you.
much.
Thank you. Okay. All right. Thanks, everyone. Really appreciate it. Thanks for your attention.
I didn't realize it.